Thank you, and welcome back to The Briefcase, where we talk all things business, investing, and real estate. Today we'll be talking about the truth behind commercial real estate loans. Now let's get into it. If you've ever looked at a $10 million building and thought, who's actually buying this? The answer is almost never someone with $10 million. It's leverage. Structured, layered, negotiated leverage. And once you understand how commercial real estate financing actually works, not the surface level definitions, but the mechanics, you stop seeing buildings as expensive and start seeing them as controllable. Today, we're breaking down the entire ecosystem, the loans, the players, the strategies, and the subtle decisions that separate average investors from the ones quietly building portfolios worth hundreds of millions. No fluff, no textbook definitions, just how it actually works. First part, why commercial real estate is a different game. Residential real estate is about people. Commercial real estate is about income. That one distinction changes everything. When a bank underwrites a house, they care about you, your credit, your job, and your debt. When a bank underwrites commercial property, they care about one thing. Can this building pay me back? That's it. You could be broke on paper, but if the property generates strong, predictable income, lenders will still take the deal seriously, which leads to a single, most important concept in this entire video. Debt is not risk. Bad debt is. Part 2. This is the core metric. This is the debt service coverage ratio. In simple terms, if your property makes $120,000 a year and your loan payments are $100,000, your debt service coverage ratio is 1.2. Banks usually want 1.2 to 1.35. Why? Because they don't trust your optimism. They want margin, cushion, room for things to go wrong. And here's where it gets interesting. If you increase the income, even slightly, you unlock significantly more borrowing power, which is why sophisticated investors don't just buy properties, they engineer income. Part 3, the main loan types. Let's break down the major loan types you'll encounter. Number 1, traditional bank loans. These are your standard commercial mortgages, fixed or variable rates, 20 to 30 year amortization, and 5 to 10 year terms, balloon payments at the end. They're conservative, predictable, slightly boring, which is exactly why institutions love them. But here's the catch. They require strong financials, experience, and often personal guarantees. The second one is SBA loans and 504. If you're an owner, operator, this is where things get interesting. SBA loans allow lower down payments, as low as 10%, longer terms, and favorable rates. But they come with rules. You need to occupy at least 51% of the property. This is not for pure investors. It's for business owners acquiring real estate. Think, dentists buying their office, restaurants buying their location, or entrepreneurs locking in rent. The third is bridge loans. Bridge loans are short-term, high-speed, slightly aggressive financing. They're used when the property isn't stabilized, you need to close fast, or you're planning to improve the asset. Higher rates, shorter terms. But they unlock deals that traditional banks won't touch. In other words, bridge loans don't solve problems. They buy time to fix them. The fourth is commercial mortgage-backed securities. This is where things scale. These loans are non-recourse, usually, packaged and sold as bonds, and used for large, stabilized assets. The upside? No personal guarantee. The downside? They are incredibly rigid. And once you're in, you're in. No flexibility and no renegotiation. Great for stability, terrible for adaptability. Number 5, these are hard money loans. These are fast, expensive, and unforgiving. These are used primarily for distressed deals, flips, and opportunistic acquisitions. Think of hard money as pay me now or miss the deal entirely. Part 4, amortization versus term. This is one of the most misunderstood concepts. Let's simplify it. Your amortization might be 25 years, but your loan term is only 5 years, which means you're making payments as if the loan lasts 25 years, but in 5 years. The remaining balance is due. That's called a balloon payment. And this is where strategy matters. You don't pay off most commercial loans. You refinance them. Part 5. How investors actually make money. Here's the part no one explains properly. Most of the money in commercial real estate is made through refinancing, not selling. Let's walk through it. You buy a building for $2 million. You improve operations, increase rents, and reduce expenses. Now the building is worth $3 million. You refinance, pull out tax-free cash, still own the asset. Repeat. This is called the BRRRR strategy. Buy, rehab, rent, refinance, and repeat. Except at scale. It's less of a strategy and more of a system. Part 6. The people behind the deals. Loans don't exist in isolation. They exist inside relationships. These are the key players: mortgage brokers, bankers, underwriters, attorneys, CPAs, and sponsors. If you think deals are won on spreadsheets, you're missing half the picture. Deals are won through trust and access, which leads to one of the most underrated skills in the industry: knowing who to call. Part 7. How to build connections. Let's be practical. If you're starting from zero, you don't need capital first, you need proximity. And these are the ways to build it: local real estate meetups, LinkedIn outreach, done correctly, not spammy, interning with brokers or investment firms, or attending industry conferences. And here's the key: don't ask for deals. Ask better questions. What are lenders tightening right now? What deals are no longer working? And what are you avoiding? Smart questions signal competence. Competence equals access. Part 8. This is risk. This is the part people ignore. Leverage amplifies outcomes. That's the benefit and the danger. Common risks: interest rate spikes, vacancy, over-leveraging, and poor underwriting assumptions. The biggest mistake beginners make? Assuming everything will go right. Professionals assume something will go wrong and structure around it. Part 9. Loan structures you should know. Let's go deeper. Interest-only loans. Lower payments early, higher risk later. Next, fixed versus floating rates. Predictability versus flexibility. Next, recourse versus non-recourse. Do you personally guarantee the loan or not? Spoiler: non-recourse sounds great until you realize the terms are stricter. Part 10. How to actually start. If you're watching this thinking, okay, but where do I begin? Here, let's be practical. Number 1, learn underwriting. This is your foundation. Number 2, analyze deals daily. Number 3, network intentionally. Number 4, start small or partner strategically. Number 5, focus on one asset class, whether that's office, retail, industrial, multifamily. Each behaves differently. Master one before touching the others. Part 11. These are all the tax strategies. This is where real estate quietly becomes one of the most powerful wealth vehicles. There's depreciation, cost segregation, interest deductions, and 1031 exchanges. These aren't loopholes. They're incentives built into the system. And when used correctly, you can generate income without showing income. Remember, commercial real estate isn't about buildings. It's about cash flow, structure, and timing. The buildings are just the container. The real game is understanding debt, managing risk, controlling assets, and thinking long term. Once you see that, you stop asking, can I afford this? And start asking, can this asset support the structure? That's when everything changes. Now, here's a fun fact that most people don't know. Every time you walk into a shopping center, office building, or even a fast food chain location, you're not just entering a business. You're stepping into a carefully engineered financial system. In commercial real estate, the value of property isn't based on what it costs to build. It's based on how much income it produces. Let's say a small retail plaza makes $100,000 a year in profit. If investors are willing to accept a 5% return, that same property is suddenly worth $2 million. Now here's where it gets interesting. If the owner finds a way to increase that income by 20 grand, maybe by raising rent or adding a tenant, that property's value doesn't just go up by 20 grand. It can jump up by more than 400 grand or more. That's because commercial real estate runs on a hidden system called income-based valuation, where tiny changes in revenue can create massive shifts in value. So behind every lease, every tenant, and every square foot, there's a silent equation turning everyday buildings into multi-million-dollar assets. Thank you for joining us with the briefcase today. If you found any of these facts about commercial real estate insightful or confusing, make sure to leave a comment down below. And if you enjoyed this video, make sure to like and subscribe. And remember, stay smart.